Okay, in this class, we will continue to talk about the banking management. Okay, the banking management, the basics banking management. You can find the lectures on the TU models. I will use the same lectures as the previous class, and then I will move on to the new slides. Okay. Oops, I'm sorry. What happened? Oops, not this one. Let me find the lectures first because I think I'm not sure where we are last time. Risk management, no, it should be banking management. Okay, from our last class, we at the time we were talking about the liquidity management. Okay, the liquidity management. What is the liquidity management? Can anyone tell me about the liquidity management in brief, please? What is the liquidity management from last times? Let's we discuss about this one, right? Liquidity management. Can anyone give me some brief explanations of the liquidity management, please? Any idea?
So the bank needs to manage how much cash they can and how can they give out money for loan and then prepare themselves for any possible problem.
Okay, very good. Thank you very much. Liquidity management refers to a situation in which bank managers, a bank managers has to maintain, right? Have to maintain the amount of reserves and to prepare the cash for the depositors. When the depositors withdraw the money from the banks may have to make sure that they have enough money, right? They have enough money to give to the depositors when they withdraw the money. So this is the liquidity management in a nutshell. Okay, from last times I think I talked about the measures that a bank managers use to overcome the liquidity problem, right? And I think I finished the class in this slide. I just I gave you the questions from the last time that what is the implicit cost of these policies. Okay, as you know that we talk about the way that the bank managers use to overcome the liquidity problem, right? The first one is the bank can borrow the money from other banks, or we call it the interbank lending, right? And the banks has to pay the interest rate to other banks in that policy. And so for this one, the bank can borrow the money from the central bank, and the banks has to pay the central bank the interest rate too. We call that interest rate the discount rate. Okay, the discount rate is the interest rate that the central bank charge from the commercial banks, okay, who borrow the money from the central bank. So the interest rate should be the explicit cost, okay, the explicit cost. Now, what is the implicit cost of this channel? What is the implicit cost of this one? When you borrow the money, now when I call when I say you, I mean you guys now bank managers, okay? You guys are managers of the commercial banks, okay? And what is the implicit cost if you borrow the money from the central bank? Explicit cost is something that you can calculate in terms of money. You can calculate it like the fraction of money that the central bank charge But what is the implicit cost? The implicit cost is the cost that is a little bit tricky, right? So can anyone give me the idea what is the implicit cost? Because I think from our last time, I just give you this question, and then I told you that I will start my class by asking this question. What is the implicit cost of this one? So what does the implicit mean? What is the meanings of implicit? The definition of implicit in English, what it is? Implicit means, okay. I'm very sorry that I have to do this, so I will call your name. Warapot, learn with you. Okay. รักสิบคน Who is รักสิบคน Okay, it seems to me that lots of you still on still make community. Chatrin, Im Suchat, Chatrin. Who is Chatrin? Okay. So anyone, can you give me the ideas of the implicit cost? The implicit cost is something that you cannot observe directly. So when you guys are now managers, right? When you borrow the money from the central bank, as I mentioned earlier from the last class, that the central bank is the lender of last resort. Okay, lender of last resort. So when you borrow the money from the central banks will monitor your activities very closely. Okay. The central bank will monitor your activities very closely. That is the cost that we call the implicit cost. The central bank will monitor everything that you engage in terms of the transactions, lending, borrowings, everything. So that is also cost. Okay, we call it the implicit cost, the monitoring from the central bank. Why? Why it is cost? In fact, if the bank managers go to the central bank and borrow the money from the central bank, these policies or this measure should be the last measure. Should be the last measure that the bank manager will do this. So this will signal to the central bank that this bank will have some severe problem. So that's why the central bank will also lend you the money. But it's also, but it is at the expense of the monitoring. Central bank will monitor everything. Okay. Central bank will monitor everything for the activities. So this is what we call the implicit cost. Okay, this is what we call the implicit cost, monitoring by the central bank. Monitoring by the central bank. Okay. Now let's move on to the next measure that the bank managers can use to resolve the liquidity problem. Okay, for this one, the commercial banks can sell some securities out of the portfolio. Okay, from our previous examples, this bank suffers from the liquidity problem, right? And it needs 9 million. It needs 9 million. So it can sell the securities for 9 million. And the cost of this measure is brokerage and transaction cost. These are pretty straightforward because when you sell your securities in the market, you have to pay the brokerage, right? The brokerage fee, the transaction cost that incur with your transaction. So these are the costs related to this measure, okay, when you're selling the securities. And one thing that you may be, also one thing that you may experience if you use this way to solve the liquidity problem is that the capital loss. Okay, the capital loss. What is the capital loss? It is a situation that you buy high and sell low, right? Buy high and sell low. So in this measure, it is like you are forced to sell. You are forced to sell your security to the market because you need the liquidity, which is money, right? So that can be treated as a cost of this measure too. Okay, let's move on to this one. Reducing loan. This is the coldest way. Okay, why the six? In these banks, okay, we still have the liquidity problems, and in order to solve the problem, the bank managers can sell the security, right? And the bank manager can also call in loans. It means that the bank managers ask the borrowers to repay the money earlier, okay, before the expiration date or before the deadline. So for these channels, loan will be reduced to 81 million. Why? Because if you take a look back at our starting point, which is here, right? This bank suffers from the liquidity problems. So for this one, loan is equal to 90 million. In order to obtain 9 million from selling loan, in order to obtain 9 million from calling in loans, so the loan here will be reduced to 81 million. And for 9 million, we move to reserve here. And you will see the results of these measures here. Okay, this one. Loans reduced to 81 million, and we will have reserve 9 million. So the liquidity problem here in this context is solved already. Okay, it's solved already. So why it is a context way? You can see that if the bank managers call in loans or ask the borrowers to repay their monies before the deadline or before the proper date, the banks will lose the customers. Okay, the bank will lose the customers. Imagine that you borrow the money from the bank and the banks ask you to repay your debt, let's say in this December. However, when you wake up in the morning, let's say tomorrow, the bank call you and ask you to repay the loan. What will happen in this situation? So you will have to repay the money to the bank, but you will go to other banks, right? Because you will feel inconvenient with these policies of the bank. So the banks will, of course, lose the customers. And another way that bank can deal with reducing loans is that bank will not call in loans, but bank can sell the loan to other banks. Okay, bank can sell the loan to other banks. What is the cost of this measure? If the bank sells the loan to other banks, will this bank obtain the fair value of the loan? No. Why? If you observe, so if you see this whole point, you can see that I just put adverse selection here, right? So this is the reason why when you sell the loans to other banks, you will not receive the fair price. So can you link the adverse selection to this situation? Why adverse selection leads to not obtain the fair value of the loan that you sell to your friend or sell to other banks? Why? Can anyone give me? I don't. In fact, I don't like to read the names and call the names of the students from the list. I would like you guys to volunteer to answer the question. Can anyone give me some explanation why adverse selection lead to not obtain the fair value of the loan? Imagine that you guys are banks, okay? Your friends are other banks. Your friends here in the rooms are other banks. Why? Okay, please. Thank you.
It causes asymmetric
Your name is Nick, right? And I remember you very.
It causes symmetric information between the banks and another banks. So they don't know about the customer, so they may not buy at the bank.
Okay, correct. Okay, thank you very much. Correct. Because other banks don't know the qualities of the loan, right? If you remember from our first class, I think if you remember, you may find that the loan that this banks makes the loan to the customer, right, or make the loan to the borrower. Before making the loan to that customer, this bank will have to conduct research on the qualities of the customer, right? And this bank will not share that information to other banks too. So that's why we have the financial intermediary in the context of the asymmetric information. Because the bank can produce the private information and it will not share with the public. So this bank will have the best knowledge of the qualities of the customers or of the borrowers, right? But when the banks sells this loan to other banks may feel a little bit difficult to assess the risk associated with this loan. So other banks will try to keep the money as low as possible. So you will not obtain the fair values if you sell the loan to other banks because other banks don't know about the qualities of the loan. So they will not give you the fair price. Okay, they will not give you the fair price. Do you have any questions? Okay, thank you. And this is what we call the adverse selection. Okay, this is what we call the adverse selection. Adverse selection presents in this situation. That's why you will not obtain the fair values of your loan. Okay, and you will see that from our four measures that we use to overcome the liquidity problem, we will have cost incurred to each channels. Okay, so if you were a bank manager, you may have to make a decision based on this information. Okay. Okay, I think that is all about the liquidity management. When we talk about the banking management, we tend to emphasize four areas of the banking management. The first one, the classic one, is the liquidity management. That's the one that I just presented. And the next one is the asset management. Okay. In a nutshell, asset management is the way that the bank manager try to keep the qualities of the asset. Okay, in a nutshell, the bank try to keep the values of the asset. So you can see there are let's say four ways that the bank can use to keep or to maintain the value of the asset. The first one is that the banks will have to research and we have to find the borrowers who are default free. Okay, who are default free, and borrowers. These borrowers should be able to pay high interest rate because the bank obtain the income from the interest rate that they charge from the borrower, right? So the banks may have to keep checking the qualities of their borrowers. So they have to make sure that these borrowers are default free. Okay, are default free. Next, buy high return and low risk securities. As you can see on the asset side of your bank, you can see the simplified versions of the balance sheet. You can see that these loans are what related to borrowers, right? And we also have the securities. You can see that the asset side of the bank is in the form of a portfolio. Okay, the portfolio. So for this one, if bank have to buy the security, they have to make sure that they can buy security with high return, or will reward them with high return with low risk. Low risk. This is also straightforward, but in reality, it is very difficult to find the securities with high return and low risk. Why? Because if you would like to have high return, you will have high. Sorry, if you would like to okay, sorry. If you study what we call CAPM or capital asset pricing modules, you will find the very short and very meaningful sentence that high risk, high what? No, high risk, high expected return, not high return, not high return. If you say high risk, high return, I think that is not quite correct. Okay, high risk, high expected return because you expect higher return. So in order to obtain a high return or high expected return here, banks or bank managers they they have no choice. They have no choice, but they have to invest in securities with high risk, right? But the decrease of the risk, the banks may have to make sure that they can, they can access this risk. How can the bank deal with the risk associated with the securities? Bank can deal with this risk by diversification. Okay, by diversification, and bank can implement the risk management strategies with this channel too. I think you will study derivatives in I don't know maybe in the next 4 or 3 class. I'm not sure. We can use derivatives such as the futures options to hedge the risk associated with these securities in the banking portfolio. Okay. Okay, and the last one that I would like to talk about the asset management is the liquidity. As you know that the banks obtain the income from the interest rate that they charge from the borrowers, right? And the cost associated with the bank's activities is the interest rate that the banks has to pay to the depositors, and also the cost of management. Okay, those are costs that the banks has to pay. As a result of this, banks will have the tendency to hold liquid assets, okay, the liquid assets, because these liquid assets are easy to liquidate when the banks need cash. Cash is king, okay, cash is king, especially during the financial crisis or especially during this time, okay, COVID-19. You will see that lots of investors try to liquidate the asset and try to hold everything in cash, okay? Because cash is the most liquid asset in the world. So these are also about asset management. So in conclusion, banks try to maintain the quality of the asset. Okay, banks try to maintain the quality of the asset. Next, liabilities management. Okay, liability management. This is also the same. We also apply the same logic. We also apply the same logics as an asset management. That is, banks may have to find the lender or the creditors with high qualities. Okay, so these are also about asset and liability management. As I mentioned earlier, I told you that there are 4 areas when we talking about the banking management. The first one is the liquidity management. The second one is the asset. The third one is the liability, and the last one is the capital management. When I talk about capital, I mean the net worth of the commercial bank. What is the net worth of the commercial bank? It is the difference between asset and liability. We call it net worth. Sometimes we call it capitals. Sometimes we call it equity. You can use this word interchangeably. Okay. Now let's examine capital adequacy management. I will use these simplified versions of the balance sheet to give you the idea what is the capital adequacy management. You can see there are two banks on the slide, right? There are two banks. The first one here, we have the reserve 10, loans 90, so we will have assets set to equal 100 in total, right? So because this is the balance sheet, we also have deposit 90, capital 10. And you can see on your right hand side, we also have the capital here equal 4. We have deposit 96. You can see that asset side and liability side here, they are 100 in total. Okay, the value of asset side equal to the value of liability side, which is 100 in total. So you can say that the bank on your right hand side is the high net worth bank, okay, high net worth bank or high capital bank. And on your right hand side, this is a low capital bank or low net worth bank. Okay, on your left is high capitals, on your right is the low capitals. Okay, you can see this one. I will move on to the next slide. It's simply that you jot down something, write something. So I will let you write something before I'm moving on to the next one. Okay, before I moving to the slides, can you give me maybe your guess or your opinion? Why do we need capital adequacy management? Why? Why do we need to manage the capitals of the commercial banks? Any idea, please? Any idea? Excuse me? Sorry. Okay, thank you very much. The first reason why we need to manage the capitals because these capitals can be used to prevent bank failure, right? Bank failure. I think I talked about this already because capital is like what we call the financial cushion, right? Financial cushion. This will help prevent the bank from the bank failure or bank run. Okay, bank run. And the second reason why we need to manage the capital is that the capital itself directly affect the returns on equity. Okay, the return on equity. So this will affect the wealth of the stockholders, And the last one, the reason why we have to manage the capital is that it is enforced by the regulators or it is demanded by the regulatory authorities to let all the banks in the economy to meet some requirement, okay, to meet some requirement. And when we talk about the capital adequacy, when we talk about the regulatories that governs the capital adequacy management, we tend to think of the Basels, okay, Basels, BASEL, Basels. I think now we are in the Basel III. Basel is like a regulatory document that require banks in the economy to maintain the levels of the capitals. let's say for example, it should be 7% of the risk adjusted asset. Okay, 7% of the risk adjusted asset. Suppose that on the asset side, um, the value of the asset side equal 100, and that assets are the risk adjusted. Okay, you have to, as a bank manager, you have to maintain the capital at least 7 million or 7% of 100. Okay, this is the idea. That's why we have to study the capital management. Okay, so in this slides, I will show you the role of the capitals as a financial cushion. Okay, let's see. From the first panel here, okay. From the first panel, you will have here on your right hand side the high net worth. On your left hand side, left hand side is the high net worth, and on your right hand side is the low net worth. Suppose that these two banks make loans to the low quality borrowers, okay, to the low quality borrowers, such as the mortgage loan, and the housing situations goes a little bit against the expectation. Loans turn to be the non-performing loan. Okay, loans here, normal loans turn to be the non-performing loans or NPLs. NPL is the loan that you cannot collect the money back within 1 year. Okay, if you cannot collect the money back from the borrower within 1 year, we call that borrowers, or we call that loan NPLs, non-performing loan. Okay, the loan that cannot generate the money. So for this one, suppose that we have a non-performing loan equals to 5 million. What will happen? Now let's examine this one first. As you can see from the balance sheet is a normal situation. You will see that we have 100 in total, right, on the asset side, 100 in total on the liability side. Okay, what will happen if we have non-performing loan equal 5 million? So the bank needs to do what we call the haircut. What is a haircut? Haircut is haircut refer to the situation that bank just write the value of the balance sheet. For this one is set to 90 million, right? So when the banks experience the non-performing loans 5 million, you need to deduct 5 million from 90. Okay, so 90 here going to be 85 million. And you will see that on the left hand side, okay, on the left hand side, which is the asset side. Now you will have 95 in total, right? 95 in total. And you know that when I show you with the equation, asset equal liabilities and equity. Liability and equity. You will see that deposit here refer to the liability, right? So this one is fixed. This one is fixed. Banks cannot do anything with the deposit because deposit depends on the depositors. Okay, deposit here depends on the depositors. So when the values on the left hand side goes down, the value here will also goes down too. But the items that goes down is the capital, not deposit. For this high net worth bank will be left with 5 million of the capitals. Okay, 5 million of the capitals. So in this situation, if we apply the same situation with the low net worth banks, what will happen? You will see that because this low net worth banks has only 4 million, okay, in a normal situation. And when these banks experience a non-performing loans equal 5 million, the value of its loan from 90 million turn to be 85 million. Okay, 85 million. And now you will see the problem here. The capitals go negative. okay, minus 1 million. We call this situation the insolvency, okay, insolvency. And if the capitals is set to be negative, banks will have to liquidate the asset and sell the asset to the market, and bank will have to shut down. We call this situation bank run. Okay, bank run. When the capital is set to be negative, or when the capital is equal to any value less than zero, banks will have to liquidate all of the asset, and bank will have to shut down the business. This situation is bank run. Okay, bank run. That is why we need to maintain the level of capitals at the adequate level. Okay. So this situation we call it bank run. Can I move on to the next slide? Okay. Okay, bank needs to maintain the bank capitals to lower the chance or the probability that bank will become insolvency, okay, or become insolvent. So you will see that for the high net worth bank tend to, um, in fact, high net worth bank will survive during the situation that loans become non-performing loan. That's why if you apply this idea to our current situation in our country, you will find that lots of commercial banks nowadays try to maintain high levels of the bank capitals. Why? Because you know that this year is a little bit special, right? Um, we have the COVID-19, and we also have very high household debt. High household debt occurs before COVID-19. But when you have the COVID-19, it is like a negative and very unfavorable shock to those borrowers. And if these banks don't maintain adequate levels of the capitals, it will have very high probability or very high chance that bank will go bankrupt like this one. Okay, so that's why if you take a look at the data nowadays, you will find that lots of commercial banks in Thailand try to maintain very high level of the capitals because you can use the capitals as the financial cushion, okay, the financial cushion that prevent you from bank run or bank failure, okay. Okay, this is a quick quiz. There is no score for this one, but I need you to try. You can work in group. How does the amount of bank capital affect returns to equity holder? Can you give me the explanation? I will give you, let's say, just 5 minutes to do this, and then I will ask you to share your answer with your friends. Okay, please, then do this. You can consult your friend. How does the amount of bank capitals? What is the amount of capital? Here, this is the amount of capital. This is the amount of capital. And how does it affect the returns to the shareholders? Okay, can you do it with your friends, and then I will ask you to give some explanation on this. Finish or not? In fact, we can use the equation to explain this relationship between the capitals and the equity. But I would like you guys to come up with the idea by yourselves, and then I will give you the solution. you can use a balance sheet to make your ideas more um, more simplified. To simplify the idea, you can use something like a balance sheet or like an equation to show the relationship between two variables. The first variable is the bank capital, and the second variable is the return. Okay, I will just argue. T Thawat, T Thawat. Who is T Thawat? T Thawat, right? Okay, can you give me your idea? Okay, 5 minutes. 5 minutes. Okay, 5 minutes. 5 minutes. Sorry, again, please. The whole equity. The whole equity. 5 minutes. 5 minutes. Okay, I will monitor the situation of Thai now. When you spend time thinking of this relationship. This is like an example for your final exam. Remember that on your exam there will be multiple choice and there might be the written exam too. So let's try to figure it out. In fact, I would highly recommend you to write it down. Finish? Okay, I think 5 minutes already. Let's find mine. Okay, Titawat, are you ready for this question? Please. Okay, just tell me negative relationships or positive relationship. Negative or positive? Negative or positive? Positive between the capitals and the equity, right? Return to equity. Okay, thank you, Titawat. Very good try, very good attempt. Thank you. It really, I'm really impressed. Okay. Okay, let's move to other opinions. Bullapon, right? Bullapon. Who is Bullapon? Okay, any ideas? Negative or positive relationship between the capitals and the return? Okay, can you give me further explanation why negative? Okay, thank you very much. Oh, very good. Okay, let's see. Okay, thank you. Um, how should I start this one? Let's see. Oops. Visualizer. Okay. Oops. Okay, I will give you the template. In fact, it's not a template, it's just the idea, my ideas about this relationship. You can come up with other solutions, but it should be the same, and it should give you the same answers, like the one that I try to give you. Okay, choose this one. Okay, let's see. Let's say we have the ROE here. We have the ROE. Okay, we have the ROE. ROE equal the net profit, right? net profit. Net profit, in fact, it is the net profit after tax. Okay, net profit after tax divided by what? Here, by equity, right? Net profit after tax divided by the equity. Okay, equity. This equities is the one that is on the bank balance sheet. This one's asset, liability, and equity here is the same. Okay, the same. I don't know why my video recordings here cannot capture the monitor. Anyway, I will upload this one too. Okay, let's see. This one equity here is the same as this one here. When we link the equity to the return, in fact, we can use this one. ROE equal net profit divided by asset, multiplied here by asset, divided by equity. Okay. We call this one return on what? Yes, return on asset. And how can we call this one? How can we call this one? Asset divided by equity. We call this equity multiplier. I think you guys knows about this equation, right? Do you know DuPont ratio? Sorry, DuPont equation. DuPont analysis. Okay. So for this one, you can see that suppose that we have two banks. Suppose that we have two banks in our examples. Let's say that both banks, bank 1 and bank 2 here, ROE of bank 2. Bank 2 also has the ROA multiplied by EM. Okay. Suppose that two banks manage assets very well. Okay. So we set ROA here equal, okay, between bank 1 and bank 2. Let's say 10% or something. But it should be equal in this analysis because we would like to analyze the effects of the equities on the return, okay, on the return that affect the shareholder. And okay, from this equation, if we set ROA equal 10% for bank 1 and for bank 2 we set ROA equal 10%, you can treat both ROA fixed. So what we left is here, fixed ROA, right? Fixed ROA multiplied by asset. Assets here also fixed, also fixed, divided by equity. This one I use E, and this is for bank 1, so this guy is E1. Okay, this guy is E1. And for this one, ROE for bank 2 equal ROA, which is set to be equal to bank 1. We have the asset here, divided by this guy, which is E2. You see that we have E1 and E2 here, right? E1's in our situation. If you get back to the slide, let's say E1 equal 10 million, and E2 equal 4 million. 10 and 4 come from our slide, okay? They come from our slide lecture. And for this one, you will see that when we have higher equity here and we have everything here fixed, ROE should be lower for bank 1. Okay. For bank 2, we also have E set equal 4. Okay. I think in order to make you be clear about this one, I think I will do this version might be better. Okay, you can I write to another equation? It would be better to give you the explanation. Okay, we have ROE equal ROA, which is fixed. Okay, asset here also fixed because we have nothing to do with the asset side. Divided by the equity. Suppose that the equity goes up. Suppose that the equity goes up. Everything here is fixed, so the ROE will go down. The ROE will go down. You will see the negative relationship between the equity and the return on equity. Okay, and the return on equity. The return on equity here is what the investors concern because it's the return from the share, right? So investors or the stockholders concerns on ROE. But as a bank manager, your concern should be the amount of the equity, right? The amount of equity. So let's get back to this one. Okay, you see that this one from our lecture slides, we set E1 equal 10 and E2 equal 4. You will find that even though we have the higher fractions of the equity or we have high net worth, you can prevent your bank from bank run, but you will face the trade-off between higher equity and the lower ROE. So a bank manager faces a trade-off between two variables. Investors concerned with ROE, not equity. Higher equity is what the investor don't like because higher equity means other people will share the income with them. So return on equity will be lower. However, as a bank managers, you guys now are bank managers. You care about the level of the capital, so you may want to keep equity high. This one is the trade-off. Okay, and this is why this is rather art than science. I think you need to maintain keep balance between the ROE and equity. As a bank manager, you need to concern about the investors, and also you may have to concern about the risk associated with your balance sheet. Okay, this is why we have to study the capital adequacy management. Because this is FN251, so I just give you the very basic ideas of the banking management. If you would like to study the modules that we use to calculate the risk associated with this balance sheet, you may have to study, I don't know, maybe FN4 something or 3 something, 312 or something. I can't remember. Okay, now let me turn to our lecture. Don't worry about this written paper. I will take a photo and we will upload on your Facebook group. Okay, don't worry about this. Oops. Okay, now let's move on to this. So now you can answer this question. Okay, a bank managers will face a trade-off between the bank capitals and the return on equities. When the bank capital goes up, the return on equity goes down. And the stockholders cares about the ROE. Sometimes as a bank manager, you have to try to maintain between two variables, okay, because it affects different sides of the transaction. Okay, can I move on to the next one? Okay, would you like to have a break? I think no, because we just we just give you a lecture only 1 hour. It should be 1:30, so I will move on to this one. Okay, to sum up, we know the very basic banking management. When we talk about the banking management, we emphasize 4 areas of banking management. The first one is about the liquidity management. You have to make sure that you know the measure that we use to solve or to overcome the liquidity problems. And you have to make sure that you know the cost associated with each measure. Okay? The cost associated with each measure. This is the first one. The first the first area that you have to make sure that you know. And the second and the third one is the asset management and the liability management. Okay. For the asset and the liability management, they are also about to maintain the quality of the asset and to maintain the quality of the liabilities. And the last one, the last area is the capital adequacy management. You need to make sure that you maintain the adequate level of your capital in order to prevent the banks from insolvencies. And as a bank manager, you need to balance the levels of your capitals and the ROE, which directly affects the stockholders, okay? Because stockholders care more about ROE rather than the risk associated with the balance sheet of the commercial bank. Now, I think we should move on to the next topics of the financial institution, which is the risk associated with the balance sheet. When I talk about the financial institutions in our context, I mean the commercial banks. Okay, I mean the commercial banks. In fact, you can think about the insurance companies or the finance firms, but I think the commercial banks will be something that would be very easy for us to imagine because we deal with the commercial bank in our daily life. Okay. Okay. Now let's see the type. Sorry. The risk associated with the financial institution and the risk management. We have a lot of risk associated to this one. Okay. Let's see. When we try to manage the risk associated with the balance sheet of the commercial banks, one thing that you have to examine is the basic principles of the banking transaction. Banks are also like other firms in the economy. That is, banks try to maximize the profit, right? Maximize the profit. That is, banks need to keep higher margin between the interest rate that they receive from the borrowers and the interest rate that they have to pay to the depositor. Okay, to maintain a very high margin, because when bank obtain the high margin, it means that bank has very high profit. So this is the objective. Okay, can I draw your attention to this slide for the point one? This is the objective of the financial institution. Okay. So in order to assess the risk or to assess the safety and the soundness of the commercial banks or the financial institutions, we can use what we call the Carmel's rating. C stands for capital adequacy. This is what you have studied already, capital adequacy. A bank manager has to make sure that they maintain the adequate level of the capitals in order to prevent the bank from the insolvency. The next one is the asset quality. This is what I try to tell you about the asset management. In a nutshell, the asset management and the liability management is also about the quality of the customers, okay, the qualities of the borrowers, the qualities of the depositors. M is about management. When we talk about M here, we mean the management in the firms, okay, the administrations, the management in the organization. This is what we mean by the M or management. Okay. The next one, the next variable that we use to assess the risk associated to the financial institution is earnings. Okay. This is pretty straightforward because banks, the main objective of the firms, any firms in the world, is that those firms try to maximize the profit. So this can reflect in the earnings of that firms. Banks also cares about earnings because this will directly affect the profit and also affect the return on equity to the shareholder too. The next one, this is a little bit different from other normal firms. It is L, which is a liquidity. As you can see from the balance sheet of the commercial bank, the balance sheet of the commercial bank is really fragile. Okay, it's really fragile because banks borrow short and lend long. Borrow from the short term money and lend to the long term project. So banks, as a bank managers, we have to care about the liquidity because when the depositor make withdrawals, okay, make withdrawals or demand the payment, you have to be very ready to pay them back. Okay, that's why else come to this list. Okay, next, sensitivity to market risk. Why we have S here. As you know from the balance sheet of the commercial bank, we see that on the asset side of the commercial bank is the loans, right? Mortgage loans, commercial loans, all kinds of loans. And one item on the asset side is the securities, okay? Marketable securities such as bond, okay? Such as equity. So that's why changes in the market will directly affect the value of your asset. That's why we need to care about the sensitivity to market risk. Okay, the risk associated to the whole market will directly affect your value, the value of your balance sheet. And in fact, we can calculate or we can give the scale to the levels of the risk associated to the balance sheet of the commercial bank or any financial institutions from the Carmel's rating from 1 to 5. 1 is the best, 5 is worst. Okay. For this one, I think it is the rating that those people who work in the industry use it maybe on a daily basis. I think I'm not sure about that one, but I used to hear about this term from my friends who work in the industry. Okay, especially the people who have to evaluate the qualities of the borrower. They will use the common rating. Okay, next. Risk associated with the financial institution. In this lecture, in these lectures, I will emphasize credit risk, liquidity risk, interest rate risk, and the insolvency risk. Okay, insolvency risk. Okay, let's see. Let's examine each one in detail. What is the credit risk? Credit risk is also about the default, right? Also about the default. When you lend the money to your friends and your friends cannot pay back in full, we call that credit risk. It is a chance that you will not obtain money in full. Next, liquidity risk. What is liquidity risk? You just study about the liquidity risk from the banking management already. When we talk about the liquidity in the context of the financial institutions, we mean the situation that the depositors withdraw the money and you cannot pay them. Okay, that is the liquidity risk. So that's why we need to maintain the reserve. You need to distinguish between reserve and capitals. Okay, reserve is the money on your asset side. Capitals is on the equity side, which is on the same size of the liability when we draw the balance sheet. Okay. Okay, this is what we call the liquidity risk. Next, this is the most, I think, for our course, this is the most challenging one. The interest rate risk. Can you link the interest rate risk to the market for bond? I think you just studying about the interest rate risk already uh, for the first half of the course. What is the what is the effects of the interest rate changes on your bond value? When the interest rate goes up, what will affect the value of the bond? The bond will go down, right? And when the interest rates go down, the price of the bond will goes up. Okay, so if you suppose that your asset side you just hold a lot of debt securities, you will find that when the interest rate in the market for the debt security changes or the behavior of the interest rate will directly affect the price of the security in your portfolio. Okay. And the security is on your asset side. So changes in the interest rate will directly affect the market value of your asset too. Okay. So this one you need to uh, compute the metric that we use to assess the interest rate risk. So I will give you the idea in a few minutes. Next one, market risk. What is market risk? Market risk, I will read from the slide. It is a risk associated with the trading asset and liability due to changes in interest rate, changes in exchange rate, and other assets price. So this is the risk from the demand and supply. Okay, demand and supply from the financial markets. Because the price, you can see that interest rate, exchange rates, and stock price, all of them are asset price. And what determines the asset price? The demand and supply. The demand and supply in the financial market. Okay, we call this market risk. I just offer you another interpretation of the market risk. Even though, in fact, you may learn the definitions of the market risk from other ways. Okay. Now let's see. Next, off balance sheet. Can you give me the examples of the off balance activity, please? I think you guys should be familiar with this one, off balance sheet. Do you have any idea? Can you give me the examples of the activity that can be classified as the off balance activities, please? Any volunteer for this one? I would like to ask you because I know that you know what is the off balance sheet activity, but you may feel a little bit shy to talk, right? I know that you guys know what this one. การปิติมานะอารีวิสการวิสการ absent okay การนิทิต oh no sorry ลินลดาสันทนักพาณิชย์วิสลดา okay I know that you listen to me very carefully okay Okay, can you give me the examples of the off-balance sheet activity? Your friend cannot help you on this one. Sorry? Rent payment. Okay, thank you very much. Very good. Okay, very good. Thanks a lot for your attempt. Okay. Do you know leasing? Okay. Leasing is an example of the off-balance sheet. Why we call it off-balance sheet? If you lease something, you may have to pay the rental. So the rental's price will be recorded on your balance sheet. But the asset, and I will talk only about the asset, but the asset that you use, it cannot be recorded on your balance sheet. That's why we call this the off balance activities, because it cannot recorded on it cannot be recorded on your balance sheet. So it's called the off balance activity. Financial institutions always incur with the off balance sheet activities. And if you study the financial derivative, we can use the financial derivatives to manage the risk associated to the off balance activities. Okay, I will not emphasize on balance sheet risk, but I would like you guys to be at least knows about the examples of this one. Leasing, okay, leasing. The next one is foreign exchange rate risk. This is the risk from the changes in the currencies market, right? When the exchange rate goes up, go down, when Thai baht appreciate against the US, or when the US appreciates against Thai baht. This will somehow directly affect the values, especially if you borrow the money from other countries in US dollar. When the USD goes up or when the USD appreciate against Thai baht, you will have higher debt burden. Okay, if you don't use the financial derivative to hedge your position. Okay, next, this one I don't want to talk about this one, but at least I will give you very brief explanation. Country or sovereign risk. It is a risk associated to the country. Okay. When we talk about the country risk or sovereign risk, we implicitly talk about the government. Okay, we implicitly talk about the government. You can see that if you invest your money in, let's say, which country? If you guys are the institutional investors, okay, when you put the money in Thailand and you put the money in Japan, you will find that there might be some different, okay. So this is the risk associated to that country. In fact, it is about the government, okay. Okay, next, technological risk or technology risk. This is the risk from the disruption. Okay, when the technological progress or when we have the technological changes, this will directly affect our activity, such as the blockchain, bitcoins. And if you are a die-hard fan of the central bank, you will find that now our Bank of Thailand just has a project called Intanon. Intanon is a project that uses the blockchain, try to incorporate the blockchain into our daily transactions that related to the money transfers. Okay, Intanon project. Okay, operational risk. It is the risk that the existing technologies or support system may malfunction. Okay, may malfunction or fraudulent. It may be the fraudulent that impact the FI activity. Okay. Next one, insolvency risk. This is the risk associated to the level of your capital, okay, on your balance sheet. We have studied it already, insolvency risk. When the banks holds a lot of the non-performing loans and they cannot collect the money back, the value on the asset side goes down and it will drive down the values of the net worth. So that's why bank can go bankrupt. Okay, so this is the insolvency risk. Okay, I think now we can take a break, and I will give you 10-minute breaks for this one. If you have any question, please come to me. Thank you. 10-minute break. Okay.